Hi, I'm Corey Litzenberger from CGLTax.ca, and this is Brainstorming Plus Tax. In this episode of Brainstorming Plus Tax, I'm going to talk a little bit about what we've seen over the past few years in the terms of small business tax changes and some more changes that are coming down the pipe this year. Now, it's been slightly over a year since the tax on split income rules were introduced for the second time in that year, and I thought I'd put a small recap of what has happened in the tax community to the middle class and those working to join it since the 2015 election. The removal of the fitness arts credit was a loss of about $300 in tax savings per child. The inability to family income split was a loss of up to $2,000 per family household. The removal of the public transit credit is a loss of $260 in tax savings if you had an annual Metro Toronto pass. The removal of the federal education and textbook amounts is a loss of $558 for a full-time student. Lowering the second federal tax bracket from 22 to 20.5% was nil result for anyone making less than $45,000 a year, but saves up to $675 for everybody else. So, a family of four, a single income of $90,000 with one child in university, one eligible for fitness and arts credits, and one taking public transit, the result is that they have a federal tax increase of $3,118, but they're saving $675, so their net increase was $2,443, and that was just the beginning. In 2016, the small business deduction was frozen before the decrease was reinstated, although at a slower pace. So, for example, a $100,000 profit company was $1,500 in tax savings, which was promised by the previous government anyway. But they adjusted the dividend tax rate personally so that $1,500 in savings is removed when the money is paid out. So, really, no net savings. One step further, the rate reduction phase-in was different than the previous one, so that the same $100,000 profit business actually lost out on $500 in savings in each of the 2 years of adjusted rates. Going back to the earlier budgets, the federal government brought in a specified corporate income rules, which have a much bigger impact on small businesses in rural communities where many people are related, compared to small businesses in large urban centers. This tax change means that if more than 10% of your business income comes from a related business, both businesses must share the small business deduction. This could change your federal corporate tax rate from currently 9% to 15%, which is a 67% increase. Where we've seen this happen the most is actually in farmers that do custom work, in other words, helping out relatives during harvest and billing them for it. Then we saw the proposal, the adjustments for tax on split income, or TOSI, for adults, bringing in a reasonableness test on dividends from investments. Not only did capital from family members for startup businesses already start to dry up after the specified corporate income rules, they went bone dry after this was brought in. To make matters worse, the punitive tax rate for income splitting has a much bigger impact on the low-rate individual than the high-rate individual. The low-rate income individual can see their federal tax rate go from 0% to 26.64%, even if they only received $10,000 in dividends. What would have been nothing in any other situation turns into $2,664 in tax, which is a very large sum for a small income. But if you already made $145,000 and you were given that extra $10,000 in split dividends, then you go from 22% to 26.64%. So you only end up paying an extra $464 more than what you would have anyways. Not as big as of an impact on worrying about a penalty. The law is so poorly worded that even the CRA has issued conflicting statements on the same fact patterns regarding holding corporations and rental income and investment income since Finance first released the legislation. But, true to our word, we in the tax profession have come up with a tax workaround for this rule. However, it usually works only if you are trying to split more than $200,000 of income between two people, and you can afford my fees. But if it is less than that, you are paying much more in taxes, and I'm not sure again how this taxes the wealthy. On January 1st, 2019, the increase to the CPP that you would have to pay went from 4.95% to 5.1%, or as the government indicated, a modest $6 a month, each to the employee and the employer. However, factoring the indexing of the maximum amount, this $6 has actually turned into $12.93 per month, double what the government said it would be. This will balloon over the next 5 years to well over $43 a month more for both employees and employers in the years ahead. But based on what these numbers are telling us, it could very easily be another $90 a month each by then. While at first this increase seems small, the reality is that a small business of 5 people is an extra $776 to that employer to come up with. And when fully implemented, the extra $5,400 in payroll costs. So using that $100,000 profit example from earlier, that is like having an additional 5.4% income tax on small business. Not to be outdone, also on January 1st, 2019, we saw a new law called the Adjusted Aggregate Investment Income Rules with non-eligible refundable dividend tax on hand and eligible refundable dividend tax on hand. So, AAII, NERDTO, and ERDTO if you're trying to update the acronyms chart. The government has had many sound bites in the media talking about $1 million earning 5%. However, this is somewhat misleading as there's much more than that in play in these rules. The first such issue is rental income that may be ancillary to your business. That extra 2,500 square feet in your commercial building that you're renting out at $20 a square foot could be a problem. To make it worse, if you had been in the real estate or investment market and had a net capital loss of $150,000 last year, but you're taking advantage of a rebound this year and got back $150,000 taxable capital gain, you would pay nothing in the income tax because the loss offsets the gain. But you'll lose your small business deduction for the next year because the capital loss carryforwards are ignored in the AAII calculation. You broke even and your business tax rate is going from 9% to 15% because of a timing difference. And if that wasn't enough, the Chartered Professional Accountants of Canada recently came out with an article referring to the change that is coming down the pipe in the Canadian corporate record-keeping realm. Now, at first you're thinking, well, I already have to keep all my records for corporations until I dissolve, and then even then I got to wait 2 more years. What's the big deal? Well, unfortunately, it appears that this coming July, we're going to have a sort of piercing of the veil. Their reasoning for this change is that there's money laundering or aggressive tax avoidance or outright evasion and financing of terrorist and other criminal activities that apparently we need to go and look through every corporation to ultimately see who the end beneficiaries of that company are. Now, while I applied a crime-fighting tactic, this will be very onerous on a small business with more than just a simple corporate structure. If they decide to have a holding company to protect themselves from unnecessary litigation, or protect their assets, or protect their loved ones who may have helped them in their startup capital and put them as a shareholder, this new law would actually expose those people being generous who wanted to help start up other businesses, or who are what you would call angel investors who give startup capital in exchange for equity to get a business off the ground. Now, while other national governments are implementing similar reforms, and Canada is following an international trend, the reality is that the July 1st, 2019 proposed implementation date isn't very far away, and there's still a great deal that needs to be done. There hasn't been a clarifying of the precise rules of how we're going to track or record or report this look-through of the corporation. There hasn't been any issuing guidance from the government's perspective and no developing processes to unearth all the beneficial ownership information that may be locked away in complex layered corporate structures. So with such a dramatic shift in corporate-owned record-keeping requirements in the works, we will have to pay particularly close attention to what's coming down the tracks. For example, if I have a family that owns a corporation and they had a brother invest in them, and that brother decided to have a corporation with his wife and children as shareholders as well, and it turns out that that wife used her corporation that was with her family members to hold her shares. I mean, you can see how far back this can go and how convoluted these share structures could get. Now, how much information is the original small business corporation going to get from this structure? Therein lies the dilemma of how we're going to report and record this information, because a corporation can own a corporation, can own a corporation, can own a corporation, can own a corporation, you get the idea. And so when we go through and go all the way back through all the multiple layers, eventually we find out who the beneficial owners are. And now they're going to want us to record on this. And I personally don't see how we're going to get all that information. And to top it off, the icing on the cake that has now begun this year in several provinces across Canada that didn't already have one, we have now a carbon tax. So to summarize the tax changes since the 2015 election, they have been immense, and they have covered different areas of corporation and personal tax issues. To put it mildly, while 2016, 17, and 18 were big changes and immense overhauls to different parts of the tax system, 2019 seems to be saying, hold my beer. And with that, for CGL Strategic Business and Tax Advisors, I'm Corey Litzenberger. Thanks for listening.